Every trader knows Dow Theory. Almost none of them use it correctly. You learned higher highs, higher lows, drew some lines, and got stopped out. Over and over. Price broke the high, you jumped in, and it reversed in your face. Sound familiar? Here's what happened. Someone taught you Dow Theory as geometry. Draw lines, connect dots, wait for breakout. But that's not what Charles Dow observed 130 years ago. He wasn't drawing lines. He was reading psychology. The psychology of who is buying, who is selling, and why. And that distinction, geometry versus psychology, is exactly why 95% of traders fail with this theory. Here's something most people don't know. Charles Dow, the father of technical analysis, never wrote a single book. He wrote editorials for the Wall Street Journal in the late 1800s. After his death, S.A. Nelson and William Hamilton compiled those observations into 6 principles. Those principles became the foundation of everything we call technical analysis today. By the end of this video, you'll know how to read market structure, identify where you are in a trend's life cycle, and know exactly when a trend is truly reversing, all from price alone. 3 pillars, 1 complete system. It starts with understanding the anatomy of trends, and most traders get this wrong from the very beginning. Imagine you're standing on a beach. You see 3 things. The tide, slowly coming in, lasting for hours. That's the strongest force. On top of the tide, you see waves, rising and falling, but always following the tide's direction. And on each wave, you see ripples, small, random, unpredictable. Dow Theory divides the market in exactly the same way. The primary trend, the tide. This is the big picture, months to years. Is the market broadly going up or broadly going down? You determine this on the weekly and daily charts by reading the overall swing structure. Higher highs and higher lows equals bullish primary trend. Lower highs and lower lows equals bearish. The secondary reaction, the wave, weeks to months. This is the counter-trend pullback within the primary trend. It typically retraces 33 to 66% of the previous impulse. And this, remember this, is where smart money reloads their positions. And the minor trend, the ripple, hours to days. Dow was very clear about this over a century ago. Minor trends are noise. And in today's markets, that noise is amplified 10 times over by high-frequency trading algorithms. And here is mistake number 1. If you're applying Dow Theory on a 5-minute chart, you're not reading the market. You're reading noise. Dow himself warned against this. The minor trend is unpredictable. It's designed to confuse you. The rule is simple. Anchor your Dow analysis to the 4-hour, daily, and weekly charts. That's where structure is real. Everything below is fog. You know the 3 tiers now. But how do you properly read the swings inside each tier? Because most traders get this part completely wrong. Everyone talks about higher highs and higher lows, but almost nobody talks about what makes a swing point valid in the first place. Here's a detail that changes everything. Dow Theory emphasizes the closing price, not the wick. A swing high isn't just any peak on the chart. It's a peak where the candles before it closed lower and the candles after it closed lower. The same logic applies to swing lows. Why does this matter? Because wicks lie. A wick can spike above a level and close back below. That's not a new high. That's a liquidity sweep. But a candle that closes above the previous swing high, that's a structural change. Dow Theory cares about closes. Now, with valid swings identified, here's how structure actually works. In an uptrend, each pullback holds above the previous swing low. That's the defining feature. Not just higher highs, but higher lows. The moment price closes below a previous swing low, the structure is broken. In a downtrend, each rally fails below the previous swing high. Lower highs and lower lows. The moment price closes above a previous swing high, the bearish structure is broken. And here is mistake number 2. Probably the most common one, confusing internal structure with macro structure. On any chart, there are primary swings, the big, obvious turning points, and there are minor swings, the small pullbacks within each impulse. If you treat every small dip as a structure break, you'll be whipsawed to death. Not every dip is a trend change. Not every bounce is a new uptrend. You have to know which time frame structure you're reading. Primary structure gives you direction. Minor structure is noise. Here's a simple way to see this. Imagine price makes a strong move up over 3 weeks. Along the way, there are 4 small pullbacks, each lasting a day or two. Those 4 pullbacks create 4 minor swing lows. But the primary swing low is at the very bottom, where the 3-week move started. As long as price stays above that low, the primary structure is intact, no matter how many minor pullbacks happen along the way. The rule: always identify which swing belongs to which tier. If the primary swing lows are intact, the primary trend is intact, no matter what the minor swings are doing. You can now read structure properly. But here's the next question. Where inside the trend are you right now? Because the answer changes everything about how you should trade. This is the most practical part of Dow Theory. Every major trend moves through 3 psychological phases. Understanding these phases tells you exactly where you are and whether you should be buying, holding, or getting out. Phase 1, accumulation. The market has been falling for months. News is terrible. Retail traders are panic selling or completely ignoring the asset. Everyone has given up. But behind the scenes, smart money, institutional traders, funds, whales, they're quietly buying. They can't buy everything at once because their order sizes are massive, so they buy gradually, absorbing retail's panic selling day after day within a tight range. What does this look like on a chart? A boring, tight, sideways range after a long decline, low volume, nothing exciting, and occasionally price dips below the range, stops get hit, panic increases, and price comes right back. That's not random. That's by design. Institutions need sellers, and stop-loss triggers create sellers. Phase 2, public participation. This is the main event. Supply dries up because institutions have absorbed it all. Price breaks out of the range. Momentum kicks in. News starts turning positive. Trend followers recognize the move and pile in. On the chart, this is what you want to see. Large candles, clear directional movement, expanding volume. This is the longest and strongest phase. This is where money is made. Phase 3, distribution. News is euphoric. Headlines are screaming buy. Your taxi driver is talking about the trade. Everyone is in, and that's exactly when smart money sells. They need buyers to sell to, and retail FOMO is giving them all the buyers they need. Price might push to new highs, but the gains are getting smaller. Volume is high, but the moves are choppy. Something feels off, but the news says everything is fine. Mistake number 3, the one that destroys accounts. Buying during phase 3, thinking it's phase 2. How do you avoid this? One word: context. If the asset has been trending up for months, news is overwhelmingly bullish, and everyone around you is buying, ask yourself, am I late? And here's mistake number 4, a subtle one. Accumulation and distribution look identical on a chart. Both are ranges. Both have fake-outs. Both have sweeps above and below. The only difference is what came before. A range after a long downtrend is probably accumulation. A range after a long uptrend is probably distribution. Context is everything. One more thing about phases. In real time, the transitions aren't always clean. The breakout from accumulation into participation sometimes fails on the first attempt. Price breaks out, comes back into the range, and breaks out again later. And the shift from participation to distribution? You often only recognize it after the fact. That's why context matters more than precision. You don't need to pinpoint the exact phase. You need to know if you're early, on time, or late. The rule: trade during phase 2, the participation phase. Be patient during phase 1, and be very, very careful during phase 3. You know the 3 phases. But how do you confirm that what you're seeing is real? Dow Theory has an answer for that, and most traders ignore it completely. Dow Theory has a principle most traders either ignore or misuse. Volume must confirm the trend. Here's what that means in practice. In a healthy uptrend, volume should expand when price moves up, the impulse, and contract when price pulls back, the correction. This tells you that the buying pressure is real and the pullback is just a pause, not a reversal. When the opposite happens, volume shrinks on the impulse and expands on the pullback, that's a warning. The trend is losing its fuel. Buyers are drying up. Sellers are getting more aggressive. Now there's a practical problem. If you trade Forex or crypto, there's no centralized exchange. You don't have true volume data. Forex tick volume is a rough proxy at best, and crypto exchange volume can be inflated. So here's the rule for decentralized markets. Use volume as confirmation, not as a trigger. If everything else, structure, phases, context, aligns, low volume on a pullback is a good sign. But don't enter a trade just because volume spiked. Mistake number 5. Either ignoring volume entirely or over-relying on it in markets where volume data isn't reliable. Volume is a supporting character, not the lead actor. Price leads, volume confirms, structure, phases, volume. You have the tools. Now the hardest question any trader faces, when does a trend actually die? This is the question that separates profitable traders from everyone else. Dow's 6th principle says, a trend persists until there is clear evidence of reversal. But what counts as clear evidence? This is where most traders get destroyed. In classic Dow theory, the rule is straightforward. In an uptrend, the trend is alive as long as price keeps making higher swing lows. The trend is dead when price breaks below the most recent significant swing low, with a close, not just a wick. But, and this is the critical part, how it breaks matters enormously. There are 3 scenarios when price touches a previous swing low. Scenario 1. Price wicks below the swing low, then closes back above. That's not a break. That's what modern traders call a liquidity sweep. Institutions triggering stop losses to fill their orders. The wick went down, but the close held. Structure is intact. Scenario 2. Price closes below the swing low, but the next candle reverses immediately. This is suspicious. Wait. Scenario 3. Price closes below the swing low with a strong candle, large body, minimal wick, and the next candle confirms by continuing lower. That is a genuine structure break. That is your clear evidence of reversal. Mistake number 6, and this is the deadliest one, confusing a liquidity sweep for a trend reversal. Price dips below a key low. You panic, you sell. Price immediately shoots back up without you. This happens because institutions need your stop loss to fill their buy orders. They push price below support specifically to trigger panic selling. Then they absorb those sells and move price right back up. This is what modern traders call a market structure shift. Dow described the concept 130 years ago. Modern frameworks simply gave it a precise name. And one more thing. Before you act on any structure break, ask yourself, which time frame did this break happen on? If a swing low broke on the 1-hour chart, but the daily swing lows are still intact, the primary trend hasn't changed. You're looking at minor noise, not a real reversal. Always check. Did the primary structure break? The rule? Never act on a wick. Wait for the close. Wait for follow-through. And confirm it happened on the primary time frame. A real break has displacement, a strong, full-bodied candle that doesn't look back. No displacement, no break. Now you know how a trend dies. But before that death, there are warning signs, and reading them early gives you a massive edge. Before a trend dies, it weakens, and that weakness leaves fingerprints on the chart, if you know where to look. There are 3 warning signs. Warning sign 1, diminishing impulse legs. Compare 3 consecutive pushes in the trend direction. If the first push was a long, powerful candle, the second was shorter, and the third barely moved, the trend is running out of fuel. Like a runner whose strides are getting shorter and shorter. They're about to stop. Warning sign 2, deeper corrections. In a healthy uptrend, pullbacks are shallow. maybe 30% of the previous leg, not even reaching the midpoint. But when corrections start getting deeper, 50%, then 60, then 70, each pullback is eating more of the previous move. The buyers aren't showing up as strongly. Control is shifting. Warning sign 3, failed breakouts. Price pushes above the previous high, but then immediately reverses. No follow-through, no displacement, just a spike and a rejection. This is often the final warning before a full reversal. Now, and this is important, these warning signs do not mean you should reverse your position. They mean you should tighten your stop loss, reduce your position size, and stop adding to winners. Weakness is not the same as reversal, but weakness plus a structure break, that's a high probability reversal. Mistake number 7, treating weakness as if it's a reversal. Weakening trends can stay alive for a long time. Only trade the reversal when the structure actually breaks, as we covered in the last section. Theory is done. 3 pillars: anatomy, life cycle, death. Now let's put it all together into a 5-step framework you can use tomorrow. This is what you came for. 5 steps, 1 framework. Everything from the last 12 minutes, compressed into a system you can apply to any chart, any market, starting tomorrow. Step 1. Define the primary trend. Open your weekly or daily chart. Read the swing structure. Higher highs and higher lows. Your bias is bullish. You only look for longs. Lower highs and lower lows. Your bias is bearish. You only look for shorts. This step eliminates 50% of bad trades immediately. You never fight the primary trend. Step 2. Identify the phase. Is the market in a tight range after a long decline? That's probably accumulation. Phase 1. Be patient, don't chase. Are you seeing strong directional candles, expanding volume, clear momentum? That's participation. Phase 2. This is where you want to trade. Has the move been going for months, news is euphoric, and everyone is long? That's probably distribution. Phase 3. Be very careful. Step 3. Wait for the secondary reaction. Don't chase impulses. Wait for the pullback. Dow observed that secondary reactions retrace 33 to 66% of the previous impulse. If you use Fibonacci, that maps to your 0.382 to 0.618 zone. This is where institutions reload and where your risk to reward is best. Step 4. Confirm with context. Does volume support the trend? Are closing prices holding? Has the primary structure broken? If the answer is volume confirms, closes hold, structure intact, you have alignment. If any of those fail, wait. Step 5. Execute. Enter in the direction of the primary trend during the secondary reaction in Phase 2. Place your stop below the most recent swing low. Trail your stop as the trend creates new swing lows. Exit when the structure breaks. When a swing low is violated with a close and displacement. 5 steps. Define, identify, wait, confirm, execute. That's Dow Theory applied. Not as geometry, but as a complete trading system. That's the framework. Let's bring it all together. Let's zoom out and look at what you've just learned. 3 pillars: the anatomy, how to read market structure properly. The 3 tiers, valid swing points, closing prices over wicks, and why primary structure is all that matters. The life cycle, the 3 phases every trend moves through: accumulation, participation, distribution, where smart money buys, where the trend runs, and where it ends. The death, when and how a trend actually reverses. Real breaks versus liquidity sweeps, displacement is proof, and the warning signs that a trend is fading, and one 5-step framework that ties it all together. Define, identify, wait, confirm, execute. Dow Theory is not about drawing lines, it's about reading the market's psychology, who is buying, who is selling, and why. And you now have the tools to do exactly that, a 130-year-old theory. But the way you use it today, after this video, is sharper than ever. If this helped you see Dow Theory in a completely new light, Subscribe and hit the bell so you don't miss the next one. Next video, I'm taking this entire framework to a live chart. From a blank screen to a complete trade plan. You'll see exactly how these 5 steps work with real candles. Drop a comment below. What was your biggest Dow theory mistake? Was it one of the 7 we covered today?